Welcome to Plato's Cave for our December 30th, 2014 broadcast. My name is Doris Motormouth and I am your Poseidon news anchor. This is the daily price movement chart of the S&P 500. The S&P 500 index closed down 0.49% today to 2080.35 at 4 p.m. in New York. The VIX closed higher 5.71% to 15.92 at 4 p.m. in New York. A report today showed consumer confidence increased less than estimated this month. The Conference Board's Consumer Confidence Index increased to 92.6 in December from 91 a month earlier. The median forecast in a Bloomberg survey called for a gain to 93.9. Another report showed home prices in 20 U.S. cities rose at a slower pace in the year ended in October. China's stocks fall to pair biggest monthly advance since 2007. Bloomberg, China's stocks fell, pairing the benchmark index's biggest monthly advance since April 2007, as technology shares slumped and a gauge of utilities dropped after surging to 5-year highs. Huadian Power International Corporation plunged 6.6% in Shanghai. A gauge of small company stocks entered a so-called correction with a 12% loss from this month's peak. PetroChina Company dropped 2.9% in Hong Kong. CITIC Securities Company and Haitong Securities Company gained at least 4% in Shanghai, extending a rally in December to more than 65%. Anhui Conch Cement Company jumped 10% after changing its shareholding structure. The Shanghai Composite Index, SHCOMP, fell from a 5-year high, losing 0.1% to 3,165.81 at the close. The index, which earlier gained as much as 0.7%, has rallied 18% this month, the most among major global benchmark gauges. Trading volumes were 9.5% below the 30-day average for this time of day. Tomorrow is the last trading day of the year. Aside from corrections every now and then, the uptrend will continue, said Mao Sheng, an analyst at Huaxi Securities Company in Chengdu. The economy is set to recover gradually and there's no change in the direction of government policies. The Hang Seng China Enterprises Index, HSCEI, slid 1.5%, after surging 4% yesterday for the biggest gain in a year. Dragged down by oil producers, the Hang Seng Index lost 1.1%. The CSI 300 Index advanced 0.1%, extending this year's gain to 48%. Shanghai rally. The Shanghai Composite has rallied 50% this year, compared with a 9.6% gain for its Hong Kong counterpart. The Shanghai Index is headed for its biggest yearly gain since 2009, bolstered by a trading link with Hong Kong and expectations the government will further ease monetary policy after unexpectedly cutting interest rates last month. Recent data have been weak, with the factory index falling to a 7-month low in December and November industrial profits slumping by the most in 2 years. Official manufacturing data for December will be released on January 1st. Economists forecast a median reading of 50 for this month, compared with November's 50.3, according to data compiled by Bloomberg. Foreign investors turned net sellers of mainland stocks through the Hong Kong link today, adding 0.41 billion yuan to the daily quota of 13 billion yuan. Trading of Hong Kong shares through the link is closed until January 5th, according to the Shanghai Stock Exchange. Small caps slumped. The Chi Next Index, dominated by technology, drug and alternative energy stocks, fell 2.6%, taking its decline since its December 15th high to 12%. Some investors consider a decline of more than 10% as a correction. East Money Information Company lost 9.4% while Huawei Brothers Media Corporation retreated 4.7%, the biggest drags in the index. The Chi Next trades at 32 times 12-month projected earnings, compared with the Shanghai Composite's 12 times. Gotek Incorporated and Apple Incorporated supplier, paced losses for technology companies, sleeing 3.9%. Newsoft Corporation fell 5.8%. Investors prefer big caps, said Zheng Xianzhao, Chief Executive Officer at Nuading Asset Management. Small caps are too expensive. A measure of utilities in the CSI 300 slid 3.3%, pairing this month's rally to 29%. Huaneng Power International Incorporated dropped 3.5%, trimming the December advance to 29%. CITIC Securities said at the end of October that reform expectations will boost power producers in the medium term. Brokers rally. Energy shares led declines in Hong Kong, with China Oilfield Services Limited sliding 4.4%. Oil traded near the lowest price in more than 5 years amid speculation that U.S. crude inventories will stay at the highest level since June, offering no relief from a global glut. Anhu Conch rallied to a 3-year high in Shanghai and gained 6% in Hong Kong amid optimism over reform of state-owned enterprises. Anhu Investment plans to convert a 51% stake in parent Conch Holdings into a direct holding of the company. The move simplifies Anhu Conch's shareholding structure, Jefferies Group LLC analysts wrote. A gauge of financial shares in the CSI 300 jumped 2.5% today, extending gains this month to 38%, the best performer among the industry groups. Goyuan Securities Company led a rally for brokerages, adding 4.3% after announcing yesterday it will further expand its margin trading and short-selling businesses. Policy outlook. The outstanding value of margin trading rose to a record 687.7 billion yuan on the Shanghai Stock Exchange yesterday, according to the data from the bourse. The largest U.S. exchange-traded fund that tracks mainland Chinese stocks posted a record 8th week of inflows amid speculation that easing of monetary policies will help extend equity gains in Asia's biggest economy. Investors added $34.6 million to the Deutsche Xtrackers Harvest CSI 300 China A Shares ETF, ASHR, last week to complete the longest stretch of asset gains since its November 2013 debut, according to data compiled by Bloomberg. More than $300 million has been put into the fund since the beginning of last month as it soared 35%. China needs more easing policies to ensure economic stability in 2015 with more infrastructure investment and lower financing costs, the China Securities Journal said in a commentary today. This chart shows the S&P 500 sector performance. The S&P 500 closed minus 0.49% with utilities being the worst performer and material the best performer. Materials minus 0.08%, healthcare minus 0.48%, financials minus 0.34%, consumers staples minus 0.55%, industrials minus 0.45%, consumer discretionary minus 0.47%, information technology minus 0.63%, energy minus 0.73%, telecommunication services minus 0.96%, utilities minus 1.84%.
Europe stocks fall from 3-week high, head for December drop. Bloomberg. European stocks fell, heading for their first December decline since 2008, as energy shares slid. The Stoxx Europe 600 index dropped 0.9% to 341.02 at the close of trading. A gauge of oil and gas companies lost 1.8%. Posting the biggest loss among 19 industry groups as oil prices traded near a 5-year low. The broader European gauge has fallen 1.8% this month, with Greek equities slumping on concern about the implications of early parliamentary elections. It hasn't been a fantastic year for equities, and now those who can are taking profits. Luca Paolini, chief strategist at Pictet Asset Management Limited, said by phone from London. The concerns about Greece and the Eurozone, the price of oil, and the Fed hiking rates are not critical, but they do add up. There is this feeling that the good years of the bull market are behind us. Next year will be more difficult. The Stoxx 600 has trimmed its annual advance to 3.9%. Greece's ASE index slid 15% this month as Prime Minister Antonis Samaras failed a third time to get enough backing for his presidential candidate, prompting him to recommend snap parliamentary elections. He met with President Kyriakos Papoulias in Athens today to request elections on January 25. The opposition Syriza party leads polls as it pushes to abandon the austerity measures tied to Greece's bailout. The slump in Greek equities is affecting other countries in Europe's periphery. Portugal's PSI 20 index lost 1.7% today and Spain's IBEX 35 index fell 1%. Low volume. The volume of Stoxx 600 shares changing hands today was 43% lower than the 30-day average, data compiled by Bloomberg show. Total SA and BP plc were some of the companies contributing the most to the Stoxx 600's decline amid speculation that U.S. oil inventories will stay at the highest level since June, offering no relief from a global glut. The Stoxx 600 had rallied in the past 2 weeks as energy shares rebounded from a slump. The Federal Reserve said it will be patient in the timing of interest rate increases, and the U.S. economy expanded at a faster pace than forecast. Next plc added 3.2%, the most in a year. The clothes seller said the outlook for UK retail is improving after it reported Christmas season sales that beat analysts' estimates.
This surface was generated from our Poseidon Alpha software. It represents the S&P 500 of the last 90 days of trading. The last closing price is from December 30, 2014. The blue dots represent the drift and volatility of the returns of that day. The surface is parameterized for the last 90 days of the adjusted closing prices and with a 5 days window for drift and volatility. This volatility surface shows that early volatility was relatively low in this 90 days time frame. About a quarter way into the time series, the volatility increased to a peak of 0.016 and then decreased to a level of 0.000598 about 3 quarters through the time series. As can be shown in this surface, the last quarter of the time series has increased in volatility from the volatility lows, but the last closing price has substantial reduction in volatility. In terms of drift, the time series starts at about zero drift and then becomes turbulent for much of the remainder of the 90 days. What is noteworthy is the 5 days drift window hovers around zero with the drift trend should be slightly positive in the near term with relatively lower volatility. The RSI was 59.10, the MACD was 13.65 for fast component and 4.24 for slow component. Both the RSI and MACD show bullish signs of trend. FBI are investigating whether companies are engaged in revenge hacking Bloomberg, the hacked are itching to hack back. So say a dozen security specialists and former law enforcement officials, who described an intensifying and largely unspoken sense of unease inside many companies after the recent breach of Sony Corporation, SNARE's networks. U.S. officials have shown little appetite to intervene as banks, retailers, casinos, power companies and manufacturers have been targeted by foreign-based hackers. Private sector companies doing business in the U.S. have few clear options for striking back on their own. That has led a growing number of companies to push the limits of existing law to consider ways to break into hackers' networks to retrieve stolen data or even knock computers offline to stop attacks. The cybersecurity professionals said in interviews. Some companies are enlisting cybersecurity firms, many with military or government security ties, to walk them through options for disrupting hacker operations or peering into foreign networks to find out what intellectual property hackers may have stolen. In one case, the Federal Bureau of Investigation is looking into whether hackers working on behalf of any U.S. financial institutions disabled servers that were being used by Iran to attack the websites of major banks last year, said two people familiar with the investigation. J.P. Morgan Chase & Company, JPM, advocated such a move in a closed meeting in February 2013, these people said. A bank spokeswoman said no action was ever taken. Federal investigators are still trying to determine who was responsible, the people said. Very frustrated, it's kind of a Wild West right now, said U.S. Representative Michael McCall, the Texas Republican who is the chairman of the House Homeland Security Committee. Some victim companies may be conducting offensive operations without getting permission from the federal government, he said. They are very frustrated, McCall said of these firms. Hacking costs the global economy as much as $575 billion annually, according to a study published in June by McAfee, a security software maker owned by Intel Corporation, INTC, and the Center for Strategic and International Studies. Counterstrikes are a small part of the overall cybersecurity industry, which Gartner Incorporated projects will surpass $78 billion in worldwide revenue next year. Hacker on hacker. The idea of hacker on hacker justice raises thorny questions, including when U.S. companies can legally order international strikes on their behalf. Also little explored, so far, are the consequences of engaging hackers that may be backed, explicitly or implicitly, by states from North Korea and Iran to China and Russia. The idea of counterstrikes gained an unprecedented level of visibility when President Barack Obama vowed on December 19 to mount a proportional response against North Korea for the Sony breach, which destroyed data and leaked movies and employee mails. North Korea suffered internet outages a few days later. The White House has declined to comment on North Korea's accusation that the U.S. government played a role. Sony represents a dramatic escalation, one so punitive in nature that I think it does change the equation, said Tom Killerman, Chief Cybersecurity Officer at Trend Micro Incorporated, a Tokyo-based security firm. Trend Micro advises clients against taking aggressive countermeasures, he said. Exploding supernova. While many companies discuss hacking back in the immediate aftermath of a breach, almost none follow through, said Kevin Mandia, founder of Mandiant, the FireEye Incorporated division responsible for investigating the Sony breach and other high-profile hacking cases. Efforts to retaliate can make things worse, he said, because attackers who aren't purged from the network could escalate the assault or ramp up attacks on other companies targeted by the same group. When data leaks out, it's like a supernova exploding. You can't put a lid on it unless you're like 2 seconds behind it, and even then I don't think you can, Mandia said. Private sector companies generally opt not to do it because they are in a glass house, he added, saying firms might ask, did we really get the attackers out? Don't they currently have the keys to our Kingdom Fury fakes? Following the Sony attacks, someone appears to have struck back. Fake copies of Fury, Annie and other leaked films began appearing earlier this month on file-sharing sites, slowing the computers of people attempting to download the movies and crippling torrent sites disseminating the files, said Tal Klein, Vice President of Strategy at Adallom Incorporated, a Palo Alto, California-based security company. The fake files have now largely been eliminated as file-sharing sites have used rating systems to blacklist the decoys, he said. Sony declined to comment on the fakes or on any steps the company is taking to recover from the breach. In the U.S., companies are prohibited by the 30-year-old Computer Fraud and Abuse Act from gaining unauthorized access to computers or overloading them with digital demons, even to stop an ongoing attack. The Act exempts intelligence and law enforcement activities, allowing the government to respond more aggressively than private sector firms. There's little indication, though, that military and intelligence agencies have used their most powerful tools to shut down attacks on businesses, as the U.S. has attempted to address foreign-based hacking through diplomacy and the courts. U.S. law enforcement agencies appear to give security companies more leeway when it comes to breaching computers to gather intelligence on the hackers or discover what data they took, according to a former law enforcement official. Such work is widely done by security firms, Killerman said. J.P. Morgan proposal. Last year's discussion among banks about retaliatory strikes came after a wave of so-called denial-of-service attacks starting in 2012 that temporarily disabled several of their websites. The U.S. attributed the attack to Iran's Quds Force, McCall said. Iran denied being behind the strikes. In February 2013, U.S. officials met with bank executives in New York. There, a J.P. Morgan official proposed that the banks hit back from offshore locations, disabling the servers from which the attacks were being launched, according to a person familiar with the conversation, who asked not to be identified because the discussions were confidential. Gone offline within J.P. Morgan, the biggest U.S. bank by assets, the idea had been vetted, according to a second person familiar with the incident. Some of the people at the New York meeting, which included FBI and Treasury Department officials, as well as representatives of Citigroup Incorporated, C. Goldman Sachs Group Incorporated, GS, and the New York Stock Exchange, dismissed the idea on legal grounds, the two people said. Federal investigators later discovered that a third party had taken some of the servers involved in the attack offline, according to the people familiar with the situation. Based on that finding, the FBI began investigating whether any U.S. companies violated anti-hacking laws in connection with the strike on those servers, according to people familiar with the probe. J.P. Morgan spokeswoman Trish Wexler said the J.P. Morgan employee didn't put forth a formal plan at the meeting and that the bank wanted the government to do more to stop the attacks. The FBI questioned J.P. Morgan representatives about the incident and appeared satisfied the bank wasn't involved in hacking, Wexler said. FBI cautions people for other attendees, including New York Stock Exchange, Citigroup and Goldman Sachs, declined to comment when asked this month about the meeting. The Treasury Department, in an emailed statement, said that as the leader of cybersecurity in the financial sector, it regularly meets with financial institutions to facilitate information sharing and support post-hacking recovery efforts. Jenny Shearer, an FBI spokeswoman, declined to comment about the meeting or any probe. The FBI cautions private sector entities from taking offensive measures in response to being hacked, Shearer said. Hackers typically commandeer other people's computers, including home PCs and corporate servers, to launch attacks. Those machines may be located in friendly countries and hold the data of innocent users. Erasing or stealing data from these computers would result in collateral damage, including bad publicity and the disruption of legitimate online services. Presidential approval. The practice of reaching into or disabling computers over international borders is so sensitive that if the U.S. government disables attacking servers without the permission of the host country, the approval of the president is required, according to a White House directive leaked last year by former National Security Agency contractor Edward Snowden. The White House confirmed that such a directive exists. A spokesman for the National Security Council declined to comment on the details of the directive. Some counteroffensives that would be legally sensitive in the U.S. are mounted from foreign soil, according to people who work for several security firms. RSA, the security division of Hopkinton, Massachusetts-based EMC Corporation, EMC, that generated $987 million in revenue last year and whose clients include government agencies, banks and defense contractors, has insulated its Israeli division so that its analysts could engage in activities they might not be able to do in the U.S., according to a former employee, who asked not to be named discussing internal company matters. Stolen passwords. RSA experts in Israel send malware into online forums where stolen data is swapped, or the experts hack directly into these computers, the person said. This allows them to recover stolen bank passwords and other data on behalf of financial institutions through methods the banks can't use themselves, the person said, adding that no U.S.-based employees of RSA are allowed to engage in the activities or handle the data. RSA representatives declined to comment. An EMC spokesman didn't respond to requests for comment. The growing arsenal of unconventional services is often provided by consultants who formerly worked at intelligence agencies or the Pentagon. That has led to fears among some people in the private sector digital security business that their industry is becoming increasingly militarized. The delicacy of the issues involved means that it's sometimes difficult to discern exactly what's on offer. Route 9B LLC, a Colorado Springs, Colorado-based company, employs several people who formerly worked in the Pentagon's offensive cyber units, according to people familiar with the security firm. According to a 2013 press release, the company offers breach prevention and digital forensics services, in addition to computer network operations, or CNO. The term, as used by the military, includes cyber espionage and other operations inside enemy networks. Bob Zito, a spokesman for Route 9B, declined to comment on how the firm defines CNO. Plainside. Other companies are offering what they describe as common-sense measures to protect clients' information. Rook Consulting, an Indianapolis-based firm, has clients stipulate in their contracts how far they are willing to let the company go in guarding their information. One of the services that Rook offers is stolen data retrieval. J.J. Thompson, Rook's founder and chief executive officer, said his company will go into hackers' computers only if two conditions are met: the data must be stored in plain sight, and it must be clear that the target machines aren't hacked PCs or servers owned by legitimate consumers, businesses or government agencies. Large dataset. Thompson said that in the past 3 months, Rook yanked back a large dataset of sensitive client material from a command and control computer located in Eastern Europe. The hackers who stole the files hadn't secured them, and the server appeared to be used strictly for cybercrime, Thompson said. Rook detected and retrieved the data in less than a half hour using international computers, he said. Clients now routinely ask about what offensive countermeasures the company offers, he said. The question is very common these days, he said, and yet no one understands the consequences in full because of the absence of case law.
WTI gains on speculation. Libya disruption may pair glut. Bloomberg. Oil climbed for the first time in 4 days on concern that production disruptions in Libya may pair global surplus that's driven crude to a 5-year low. Libyan output has fallen below 300,000 barrels a day, the lowest since May, after militants shifted attacks to energy facilities including the country's largest oil export terminal, according to Energy Aspects Limited estimates. The U.S. Commerce Department said least condensate, processed through a crude oil distillation tower, is a petroleum product, exempt from U.S. export restrictions. Oil has slumped 45% this year, set for the biggest annual decline since 2008, as the highest U.S. production in more than 3 decades contributed to a global surplus estimated by Qatar at 2 million barrels a day. Saudi Arabia, which is steering the Organization of Petroleum Exporting Countries to resist cutting output, has said it's confident that prices will rebound as economic growth boosts demand. The market is rebounding on the ongoing concerns about Libya, said Phil Flynn, senior market analyst at the Price Futures Group in Chicago. It does seem that the U.S. export wall is coming down. It's another reason to cover your shorts. WTI for February delivery rose 51 cents, or 1%, to $54.12 on the New York Mercantile Exchange after earlier falling as far as $52.70, the lowest since May 2009. The volume of all futures traded was about 37% below the 100-day average for that time of day. Libya production Brent for February settlement added 2 cents to $57.90 a barrel on the London-based ICE Futures Europe exchange after sliding to $56.74, also the lowest since May 2009. Volume was 29% below the 100-day average. The European benchmark crude traded at a premium of $3.78 to WTI on the ICE. Libya's oil production is down at least 65% from a recent high of 850,000 barrels a day in October following the assault on the Poseidon terminal, according to Energy Aspects. The country holds Africa's largest oil reserves. The fighting last week marked a turning point in the unrest that followed Muammar Gaddafi's 42-year rule, according to Energy Aspects and Eurasia Group consultants. All the factions, including the Islamist militia coalition known as Libya Dawn, had committed to spare the energy industry that provides 80% of public spending. U.S. exports. The Commerce Department's Bureau of Industry and Security said in guidelines released today that the agency will review export requests on a case-by-case basis. The U.S. banned most crude exports in 1975, with a few exceptions including shipments to Canada. Exports of refined products such as gasoline and diesel fuel are unrestricted. Pioneer Natural Resources Limited and Enterprise Products Partners LP said in June that the Commerce Department has approved their plans to export condensate. The product is heated in stabilizers and distillation towers, which qualifies it as a refined fuel eligible for shipping abroad, they said. U.S. stockpiles are projected to have climbed 900,000 barrels to 388.1 million barrels last week, the highest for the period in data going back to 1982, a Bloomberg News survey shows before Energy Information Administration data tomorrow. The EIA, the Energy Department's statistical, will release its weekly report tomorrow. All this North American oil has really changed the tone of the market, said Gene McGillian, a senior analyst at Tradition Energy in Stamford, Connecticut. We have a global surplus of oil. Venezuela called a slump in oil prices has contributed to the steepest annual slide in the ruble since 1998, given crude is Russia's main export earner. OPEC has so far resisted calls from cash-strapped Venezuela to act and stem the rout in prices. U.S. production from fracking is flooding the market, Venezuela President Nicolas Maduro said in a speech broadcast on state television yesterday. The South American country had called for an output cut at OPEC's November 27 meeting in Vienna. OPEC, which supplies about 40% of the world's oil, pumped 30.56 million barrels a day in November, according to data compiled by Bloomberg. That exceeded its collective target of 30 million for a sixth straight month. U.S. production growth may slow next year as companies reduce spending in drilling, said James Williams, an economist at WTRG Economics, an energy research firm in London, Arkansas. Production expanded to 9.14 million through December 12, the most in weekly data that started in January 1983, according to the EIA. U.S. rigs targeting oil declined by 37 to 1,499 in the week ended December 26, the lowest since April, Baker Hughes said on its website yesterday, extending the 3-week decline to 76. That's the biggest weekly decline since 2012. By mid-year we should see production growth slowing, Williams said.
Thank you for listening to Plato's Cave. See you tomorrow.